everybody. Welcome to Options Brew TV, the midday market shot with Mark Phillips of Harvested Financial. So we're going to talk a little bit about a couple things we talked about in the past. Mark and I were talking a little bit prior to the show here. He's going to go over a couple things we talked about in the past and a couple new things, I think, right, Mark?
Exactly. So I want to take a look at the trade we did about 2 weeks ago in Snap and kind of review where we are there. But then pick up a new trade. Now that the election is over, the election was a big focus for us. How do we play this through the end of the year? So we'll take a look at that after we review Snap.
All right, let's do Snap. Perfect. And just while are you going to share a screen or?
Yeah, here, why don't I pull up my screen for
Okay. So refresher from Snap, right? We were looking at two different spreads, right? Two call spreads, I believe, in Snap.
Exactly. So in Snap, we were looking, this, I believe, was the 23rd of October that we were talking about this. This was almost 2 weeks ago that we were looking at Snap. And when Snap, they just come out with their earnings. So they just had a really positive earnings surprise. We saw them jump. And what we were looking at that time was the difference between the October 30th and the November 6th expiration.
Got it.
And we had some relatively wide markets at the time, and we're looking to pay around 20 cents for the 39.5 40 call spread.
Well, we're doing well already, I can tell, right? Here's what we got. We got a 41.5 stock price, and we had our strikes are beneath that, it sounds like, right?
They certainly are. So we were long the 39.5 and we were short the 40.
Perfect.
And so we paid around 20 cents, 21 cents to enter this trade. And the max value on this, of course, would be 50 cents, the difference between the strikes here. And like you say, we're well in the clear, over 41.5 right now. But an interesting thing to look at is just how wide these markets are, Lex. Like if you were going to try and get out of this spread, even though you're $1.50 in the money, you're not going to get that full value today. You're going to have to wait until tomorrow, and you're going to have to be pretty judicious about getting that full value. Currently, with a 197 bid here and a 171 offer here, if you hit the bid, you're only collecting 26 cents on that trade, even though the stock's gone $2 in your favor.
Right. Got it. Okay. Good.
So we have that spread worth about 48 cents right here, right now, though.
Right.
So it's pretty close to its max value, but execution is really going to matter here if you do want to unwind that spread.
So are we trying to get out of this at 40-ish, or are we trying to get out of this at full value or somewhere in between?
I think that really is going to depend on how much it costs for exercise and assignment in some ways, right? That if you're going to have to pay for exercise, then it might be a good do to sell out of this for a little bit lower. There's nothing wrong with taking profits either. So, seeing that 40-cent spread, you doubled your money. There's good reason to take some risk off the table here. And
So let me ask you a question, and this is more of a trading thing. I guess in the world you're in now, and probably the world I'm in now, we don't think this way as much. But could we just buy this put for 10 cents or some low number, and then leave the short side out? Of course, I mean, in our days, both those was a box, right? We lock it up, but. Is that ever advisable? If you get a cheap, you can buy that cheap put and just be done with it. I understand the exercise part of it. You might have some problems with costs there.
Yeah, no, I think that's a great point though. And I think what you're highlighting is that a call is a put and a put is a call.
That's right. Yep.
If you sell a call, that's the same thing as selling a put hedged on the appropriate delta. So really they're functionally the same thing. So it's a great point that you can actually buy that put and close down your directional risk here, but you still have that exercise assignment pinning question should that trade right around 48 expiration.
Right. And you do, it does give you one little good news play is if you just buy this, right? We've got all this downside that is the lotto ticket in case this turns over and rolls over for some unknown reason.
Exactly. And we've seen stranger things in the market. So, having those free tickets is great.
Good. Awesome. So this one did well. This was a great call.
Yeah, this was an interesting play, and going out to the November 6th, paying that extra penny for a full extra week. Snap closed on the 30th at 38.60, I believe. So had you gone for the October 30th play, this would not have been in the money. So really worth looking at what your tenors are on these trades. And if you can get that extra, time value for a penny or so, it's often worth a do.
Good. That's a good call. Okay, great. That's awesome. Very nice. I love it.
So yeah, nice little follow-up there on the trade we did 2 weeks ago. Today I want to look at, now that the election's over, we had our election on Tuesday, going into the election, we talked a lot about how bid up volatility was. We talked about how bid up volatility was in November, how bid it up further out in the term too it was also. So
Yep.
December and January were both pricing in big moves. I think with a week to go to the election, the January straddle was around 11% of the stock price, of the SPX price.
Yep.
So really expensive moves out there. And I think as this election kind of conversation winds down, we're already starting to see, and I think we can further expect to see volatility come in here. And so what that's going to do is that's going to have some potential tailwinds to the market. And what I want to set us up for is, should this volatility come in and some of these tailwinds materialize, I want an odds-on play that will really benefit should the market starts to go up. So what I'm going to look at here is a 1x2 trade.
Okay.
So let me pull up SPY here. And I'm just going to go out to the end of the year. And it's nice, SPY has so many different expirations.
Oh, look at all, yeah, it's a bazillion of them, right?
Oh, you have one every couple days all the way out to the end.
We might get a 5-day per week expiration cycle there someday.
It feels like it.
Right.
So with 56 days left to go, SPY's trading around 350. What I'm going to do here is I'm going to sell the 350 call. So sell the at the money call.
Okay.
And then I'm going to buy the 360 call, and I'm going to buy 2 of them.
Okay. Got it.
So the reason I'm picking the 360 call is actually, I'll pull up a chart of what SPY has been doing.
Okay.
This is the full year chart here, of course, but here's where we are right here.
Got it.
In early October and then in late August, we both had these highs right here.
Got it.
Market's bumping up against this, I think it's 353 level here, 358 level here in SPY.
Yep.
The reason I'm picking that 360 strike is that if we break through here, there's potential to really see some tailwind going into the end of the year.
Okay.
So not only is there a little bit of a technical indicator here, but I want to go back to some of that vol compression idea too, because a lot of the back or the tailwind into the market can come from the way dealers are positioned. And talking about volatility coming in, and especially coming in really significantly off these highs, we're going to see a lot of Vanna compression. And so what that means is market makers tend to be short puts and long calls. And so if you're short that put and long that call, when the volatility comes in, because of the different implied vol levels, you're actually going to be short deltas as that vol comes in. And so the market makers are going to be long Vanna, which means they need to start buying deltas as vols coming in. As the vols coming in on their puts and the vols coming in on their calls that they're long, they're going to end up buying a lot of deltas. So as we see this volatility come in, we're going to see a lot of demand for hedging on the buy side.
Okay, let me interrupt. Sorry, Vanna is a term that probably most people don't understand, right? I'm guessing. It's not part of the. It's probably not part of the natural Greek cycle, right? The delta gamma theta vega rho. It's another set of derivatives, I think.
Yeah, it's the next order of derivatives. So it's how your vega is going to change relative to delta.
Got it. So you can have the implied volatility shifts that will affect the delta as well in this component of, isn't that part of Vanna as well?
Exactly. So as we see the short puts and long calls both come in, right, they're at different points on the skew curve. So as we see those both come in, that's going to leave the dealers, the market makers, short deltas.
Got it.
And so they need to start buying stock.
Okay.
And so with vol coming in, with us pushing against this technical breakpoint, we want to look for a nice upside surprise should we get through there.
Got it. Awesome.
So the way I want to set that up is with a 1x2. And 1x2s are a really interesting play because I like to think of it as sort of short a call spread and then long a call. And I think once we take a look at the what if scenario, that'll really demonstrate what we've got going on here. So
yeah, maximize that baby. Perfect. Okay, good.
So sitting right here around 350, we're going to pay around $1.80 to enter this trade.
Okay.
So I think we could sell the 350 call at around $13, and I think maybe $14, and I think we were paying $7.50 for the 360 call. So we're paying about $1.80 to get into this trade, and that's going to be our max loss should we stay below the 350 level.
Right. And
That's
yeah,
the debit we want to do.
that's visual right here on the screen. I'll just draw on it since you keep doing your thing there. So that's about where you're talking where that 180 kicks in, right around that 350 mark.
Exactly. So any price south of there, we've lost our $1.80 a contract.
Got it.
Since we're short a call spread, as stock moves from 350 up towards 360, our long strike, we're going to increasingly lose money. It's going to go down, and it's going to behave very much like a short call strike, short call spread.
Yep.
Because it's a 10-point vertical, we look to lose around $1,000 should that go right up to our long strike.
Yep.
Now here's where the fun starts kicking in. Above 360, we actually start picking up 2 to 1 because we're long 2 of those calls.
Yep.
So we've got to offset our short call.
Yep.
But a little north of 370, we start we hit our break even point, and it's unlimited from then on out.
Look at that.
Stock keeps going up. We just keep seeing our spread increase in value there.
Yep.
So we offset the 2 upside calls that we purchased at 360 by selling that at the money and giving ourselves, we do have this loss range for those first 10, $20 really. But should these tailwinds materialize, like we really have a nice unlimited profit potential should this Santa Claus rally materialize this year.
Right. Cool. Let me ask a question. So we're clearly looking at, this graph at expiration, right? Which is, as you said, I think 56 days away roughly. So we've got to live with this for 56 days. So I guess my question is, we don't want to panic early, right? So we don't want to get into my box zone here and start freaking out, right? Within 10 days, like, oh my God, it's going to settle here and I got to get out of this thing because that's where my max loss is, right? So is there any recommendations of emotion? I know it's a hard thing to do, right?
I think the best thing a trader can do is have a system to deal with their emotions, because once you start making emotional decisions, that's, you start getting yourself in trouble. But I think that's a really interesting point to consider as you're entering a trade. Where is my max pain going to be?
Yep.
And, understanding that for those first couple days, if we go to 360, 370, that might look like your max loss at expiration, but your option still has a lot of time on it. And you want to let this one play out for that full, 56-day cycle.
Right. If you hit one of these buttons down here, that's a shorter time. Let's see what happens if you hit there. So clearly what you see there when you did that, right? It pulled up that max loss value. So it's not the most ugly thing in the world in, whatever that is. It's a couple weeks, I suppose, right? So you can see that it's not a panic point in a few days, right? So there's hope there, I should say.
Exactly. And I think this option isn't going to mark terribly against you. So I think, going through that cycle, we see it slowly decay.
Yep.
But for the most part, this option doesn't really, or this spread, I should say, doesn't mark against you too badly until you really start settling in this area as you're approaching that expiration on the contract.
There you go. Good. So you have time. You have a little time on your side with this one, not a panic situation. And tremendous upside, right?
Exactly. We sacrifice a little bit of this near-term upside to really have that sort of unlimited potential once we cross our break-even point just north of 370.
Perfect. That's a great graph. Good. Awesome. Very
good. So fun with 1x2s. That's a new spread for us. But they're really interesting to play on both the long and the short side. Of course, the short side would open you up to unlimited risk, but they really have some nice staging potential for picking certain levels and targeting potential breakouts for relatively minimal capital outlays.
Great. Awesome. Oh, that's good stuff, Mark. Okay. Terrific. I love it.
So we'll keep an eye on this through the end of the year.
Okay, good. We're going to put this in the memory bank. So we'll have this on the channel. I'll send it over to you, Mark, as always, and you can post it when we're all done with the editing, and we'll get another good series out there.